Hello there, welcome to Intermediate Accounting 2, Chapter 19, Part 2. So we've already looked at most of the information for this chapter in Part 1 of the previous video. This video is going to be showing you how to do the pension expense for IFRS for defined benefit plans. So as just a recap, there's two types of pensions: a defined contribution plan, where the contributions are fixed and the benefits are variable. So what the employer has to put into the fund is fixed. What the retirees are going to get when they've retired is variable. For the defined benefit plan, it's the opposite. What the contributions are going to be that the employer has to contribute are variable. And the benefits that the retired members get are fixed. So they'll know with a type of formula, 2% times their final year salary times the number of years of service could be the type of formula that they would use to determine what the benefits will be. So the employer has to ensure that there's enough money in the fund in order for the retired members to get what they need to get. We first looked at defined contribution plans. We know that that's a simple journal entry: debit your pension expense, credit your cash. For defined benefit plans, we went through the defined benefit obligation, so the liability you have to set up, the pension plan asset. So you know the components of what you add and subtract in order to get defined benefit obligation. In order to get pension plan asset, you're going to subtract the two, and that's going to get your net defined benefit asset or liability. And that's the net amount is what shows up on your statement of financial position. Okay, so not both the liability and asset, just the net amount, whatever the greater is. If the greater amount is the liability, then you'll have a net liability. If the greater amount is the asset, then you'll have a net asset. We also went through what are the components of pension expense under ASPE. So today we'll recap the pension expense under ASPE. I'll show you a different way of reporting it or showing it, and then we'll go through the pension expense for IFRS. So just a recap again. So pension expense under ASPE, you're going to include your current service cost, your interest cost. Your interest cost can be calculated by taking the opening balance of your defined benefit obligation, so of your liability, and multiplying it by the discount rate. Then you're going to subtract your actual return on plan assets. You're going to add your past service costs, and you're going to add your actuarial losses to your pension expense or subtract your actuarial gains to your pension expense. So I just want to show you another setup on how to do the pension expense. Before we do that, let me just quickly explain the journal entry again. So after you figure out your pension expense for the year, you do one journal entry to record pension expense. So debit pension expense, credit net defined benefit, asset liability. And the second journal entry you do is to record the cash contribution. So you debit net defined benefit, asset liability, and then credit the cash on how much cash is being contributed into the fund. So there is this pension worksheet that companies use in order to keep track of all the relevant pension items and all the components that they're reporting off balance sheet. So what's being reported off balance sheet is the asset and the liability amount. So really only the net amount gets reported in the balance sheet. So in order to keep all this information available and kind of in an organized way, we use the pension worksheet to do this. So let's go through a question where we're going to use ASPE. So let's just do another ASPE question, and we'll look at the pension worksheet and how that all works. So if you go into Chapter 819, Part 2, extra class exercises, go to question 1. I'll pull that up here. So question 1, it gives you some information on January 1st. This is what they had in their account, or they had assets, so plan assets of 470 and a liability of 510. During the year, the following was incurred: your current service cost, we have the discount rate, we have an actual return on plan assets, contributions into the pension plan, the benefits that were paid. So these were paid to the retired members, right? So benefits paid always means the amount of money that's going to the retired members. Remember, the employer does not pay this amount. The fund, whoever's looking after the fund, so maybe the trustee, will pay that amount, not the company. So the only amount that the company is paying is this contribution amount of 80,000. Then we have some past service cost, and we have an actuarial loss. The question says, prepare the pension worksheet and journal entries for pension, assuming the company follows ASPE. Okay, so this is what a pension worksheet is. It shows the pension expense account, it shows the cash account, and it shows your net defined benefit asset or liability account. So these three accounts are going to be on on the balance sheet / income statement, right? So your pension expense is going to go into your income statement, and cash and your net defined benefit asset or liability go into your balance sheet. And then we have this big black line that distinguishes what's going to actually go into your statements and what's just going to be a memo record. So the defined benefit obligation, that liability amount, is not going in your financial statements. Remember, it's just the net amount going in. And your pension plan assets is not going into the financial statements. It's just the net amount of these two that are going in. Yeah, so this is a good way to keep track of all these numbers and then to find out what your journal entries are going to be at the end. So when we did the question 2 for chapter 19, part 1, we were not using this pension worksheet. We were just calculating what our defined benefit obligation is, what our pension plan assets, and what our annual pension expense was. But you'll see that this worksheet is, it might be an easier way for you to do it. It might be a bit harder. On the exam, make sure you know both ways, because both ways could be tested there. Okay, so before we get started and start inputting things into our workshop, why don't we calculate the interest cost so we have that available for us when we start inputting. So like I said, usually we're going to take our discount rate to multiply it by the defined benefit obligation at the beginning balance at the beginning of the year. I had talked about what happens when the past service costs are granted at the beginning of the year, or January 1st. When past service costs are granted at the beginning of the year, this 21,000 should be what should be part of the opening balance of the DBO, because this past service cost is going to go into your liability balance. Remember, by the time we get to the end of the year, we're going to include it. So when you're figuring out your interest costs for the year, you should include this 21,000 with your opening balance of your DBO in order to determine what the interest rate is, or interest cost is. Okay, so interest cost, the way we're going to figure that out is we're going to take our opening DBO, which is 510, and we're going to add our cost of past service, because it was granted January 1st. So it was granted at the beginning of the year, so technically it should be included in the opening balance of the DBO. We're not going to do it until we do our worksheet, but in order to calculate the interest cost, we want to do that. So we're going to add the DBO and the opening balance, the opening balance of our DBO plus the cost of past service, only because it says the cost of past service was granted January 1st. If it said the cost of past service was granted December 31st, then you wouldn't be adding this 21,000 to your DBO to determine your interest cost. You would just take your discount rate, multiply it by the opening balance of the DBO. Like if you remember from the last video, this past service cost was granted December 31st, so we didn't have to do anything with it when we were figuring out our interest costs. But because this is granted at the beginning of the year, and you're supposed to use the opening balance of the DBO, this technically should be added. So you're going to multiply that whole thing by 10%, and that's going to give you your interest cost for the year. All right, so let's go and do our schedule now. Input everything into our worksheet. Okay, so first we're going to start with the balance of January 1st, 2016. So we have assets of 470,000. So anything that's an asset or a debit amount. So anything that has a debit balance should be a positive amount on our worksheet. Anything that has a credit balance or is going to be credited should have a credit or should have a negative amount on our spreadsheet. Okay, so these are negatives, so they're credits. Anything that's positive are debits. So our plan assets should be a debit amount, and therefore we're going to debit 470,000. Our opening balance over DBO, that's a liability, so that's going to be a credit amount, so it's going to be negative 510. Negative 5, looking at the difference between these two is going to give us our net defined benefit, asset or liability. So negative 510 plus 470,000 gives us negative 40, right? So this is off by, difference is 40,000, and it's a negative because your liability is higher than the asset. So right now, the opening balance, we have a net defined benefit asset. We have a liability actually of negative 40. It did tell us in this question what the net defined benefit was, but we can figure it out by subtracting the two opening balances. I think in our last question in the last video, we had a line item that said what the net defined benefit was, but in this case, we could just calculate it. Okay, so let's just go down the list and add what we need to on our spreadsheet. So current service cost was 21,890. So what we're going to do is we're going to debit our annual pension expense, 21,890, because as we will look at our little cheat sheet, where are we? Right there. So our pension expense for ASPE, we're going to include or add our current service cost. So we're adding our current service cost. So that's going to make our expense, increase our expense, right? When you increase an expense, you debit the expense. So what we're doing is we're debiting our current service cost into pension expense. For this spreadsheet or worksheet to work, we have to have a debit and we have to have a credit. So our debit's going to go into pension expense. Our credit, if you remember from the previous last video's PowerPoint slides, our current service cost increases our defined benefit obligation. So therefore, if you have a liability and you want to increase your liability, we're going to credit the amount. Okay, so we're going to have a negative 21,890 on our defined benefit obligation. So you always want to have a debit and a credit. So the way that I do it is any positives here are debits, any negatives here are credits. Another way to do it, which the textbook does as well, is right beside the number, you can write debit here, and you can write credit. Okay, just to show that this is a debit, this is a credit. So either or, so either you have the negatives for your credits and you have a positive for your debits, or you write debit credit beside each one. Whichever way works for you, you can do that way. All right, so the next one is our, so we were talking about our discount rate, so we calculated our interest cost, right? So we're gonna bring this 53,100 down. And there's our interest cost. So I'm just going to highlight everything that we've done in blue. Our interest cost is going to increase our pension expense, so it's a debit to pension expense, and it's also going to increase our defined benefit obligation, which is a liability balance. So to increase the liability, we would credit the amount. Next, let's just go down the list and add these one by one. So our actual return on plan assets was $62,000. So we are going to add this where. So if we go back to kind of our cheat sheet, we know that pension expense, you're going to subtract your actual return on plan assets, which means you would have to, if you have pension expense, anything that's going to decrease your expense is going to be a credit. So what you're going to do, so these really, I'm just going to make whatever we already did blue so we can just keep track. Okay, So here we're going to credit our annual pension expense. So that's why it's a negative amount, because it's going to decrease our pension expense. Anytime you have a return on something, you're getting more money. So that would decrease the expense. And then where would the debit side go? So if we go back to our little cheat sheet, so these are our last video part, chapter 19, part 1 slides. We have our opening balance of our pension plan asset. We're going to add our contributions, add our actual return on plan assets, subtract our benefits. Okay, so we're adding something to our asset. If we're adding something to our asset, we're going to be debiting that amount. So we go to our asset column and we're going to debit the $62,000. And then let's go to the next one. The next one on this list is your past service cost. So you can do this in any order. The next one here was the past service cost granted January 1st, 2016 of $21,000. All right, so we can go back to our cheat sheet, and you notice that past service cost is going to be added to our expense, and past service cost is going to be added to our liability, our defined benefit obligation. All right, so we're going to do the same thing here. We're going to take our past service costs. 21,000 is going to be added to the pension expense, so debit pension expense. And we're going to credit our liability, so it's going to be a negative amount for our liability. The next one, we can do our contributions. So contributions into the pension plan was 80,000. If we look at our pension expense, the contribution is not in here. Our pension, so it doesn't affect our pension expense. It doesn't affect our defined benefit obligation. It does add to our assets. Okay, so we're going to add our contribution amount. It's going to increase our assets. So that's the debit part. Where would the credit part go? So think about, so out of all of these, and I told you to leave net defined benefit alone for now. So don't put anything in there, which means it's going to credit cash, right? If you're going to put money into the pension fund, that's going to decrease the cash in the company. So we're going to credit our cash because the cash is being taken out, and we're going to debit our pension plan asset column. Okay, so when we have contributions, that's going to increase our asset, but it's going to decrease our cash. So we credit our cash. All right, next one, benefits paid or $37,000. We go back into our cheat sheet or PowerPoint here. It says that benefits paid to retirees get subtracted from our asset. So if something gets subtracted from our asset, it's going to be a credit amount. And for our liability, it also gets subtracted. So if something gets subtracted from a liability or decreases your liability, that's going to be a debit to your liability. So here, 37,000, we're going to debit it from the liability amount because it's going to reduce our liability, and we're going to credit it from the asset amount because it's going to reduce our asset as well. And then one more thing, we have this actuarial loss of 18,000. Again, if you look at our cheat sheet, an actuarial loss is going to be added to our liability, and an actuarial loss is going to be added to our pension expense. So we're going to debit our pension expense and credit our liability to increase both of those. And so 18,000 gets debited in our expense account and then gets credited, or a negative amount, in the defined benefit obligation. All right, and that's all. We've dealt with all of these numbers. So we're done now. We can total everything up. So basically total up all these columns. So the sum of all of these. So there's 5 numbers that go into calculating pension expense, and the actual return is going to be subtracted. So that's 51,990. Our cash, make sure you follow along the signs. That's going to be important. So it's going to be a negative 80,000, right? So negative 80,000, that's our total. I just bold this because those are our totals. I told you not to do anything with our defined benefit net defined benefit asset or liability yet. So just leave all that blank. So carry forward that 40,000 opening balance. Our defined benefit obligation, add everything up, subtract the 37,000 benefits paid. So we get negative 586,990. And then pension plan assets, start with your opening balance, add your return, add your contributions, subtract the benefits paid, and 575 you should get. Okay, so that's all totaled up here. The next thing you do is you look at what are your journal entries. So we have pension expense of 51,990. We have cash, so pension expense being debited because it's a positive amount. Cash is going to be credited because it's a negative amount. And so these are the only two things that you're gonna have journal entries for. This defined benefit obligation and pension plan assets, we don't have journal entries for those because we're only concerned with the net amount, right? We're not updating a separate liability and a separate asset. We're only updating the net amount. So how you do that, you can do your journal entries. So your journal entry is going to be debit pension expense, 51,990. So just take your column amount. And then you're going to credit your net defined benefit asset or liability. In this case, it's a liability because it started off as a negative. Okay, so you're going to credit that. Your next one is going to debit your net defined benefit liability amount, 80,000, and credit cash, 80,000. So the only journal entries you're doing are on the first two columns. Right, so you're debiting your pension expense, crediting this net defined benefit. You are debiting the net defined benefit, crediting your cash. So what we can do now, since we know what the journal entries are, is we can update this 40,000 net defined benefit and figure out what the amount is actually now. So the pension expense entry, remember we said we're going to debit our pension expense, which means we're going to have to credit our net defined benefit asset or slash liability, right? So we're crediting our net defined benefit amount. So let's update our net defined benefit amount here. So it's going to be a credit of 51,990. And our contribution entry or our cash entry is going to debit our net defined benefit. So that's a positive amount, and credit our cash. Right? So basically we're just showing when we do these two entries for pension expense and cash, what is it doing to our net defined benefit account? So it's crediting the pension expense amount, and it's going to debit how much we have to pay, what the contribution is. That's going to be debited to the net defined benefit. So if we total this up now, we started off with a negative 40,000 or a credit of 40,000. So if you just do a quick T account here, maybe that might be easier for some people to follow. So here, just bring it down a little bit so you can see the journal entries. Okay, so if we hit a T account for a net defined benefit, it's supposed to be net defined pension benefit, and it's an asset or liability. We started off as a negative, so credit amount of 40,000, right? Debits, just a quick recap, debits go here, credits go here. So we started off with 40,000. We did a credit of 51,990, right? And then we did a debit of 80,000. So what are our total balance? Start off with 40,000, added the 51,990, subtracted the 80. So we have a negative or a credit balance of 11,990. Okay, and that's how we get this balance here. So our balance in our net defined benefit now, it went from a credit of 40,000 to a credit of 11,990. All right, so I hope that makes sense of why this is 11,990. Make sure you have your debits and credits or your negatives and positives done correctly, because if you don't, then that's gonna mess up your calculations and your totals. All right, one way to check if you did this right is we know our net defined benefit is going to be the net amount of our asset and liability. So we have here showing what our ending amount of our liability is and what our ending amount of our asset is. If we take the difference between those two, so the difference between our negative 586,990 and our 575, we take the difference, it's going to give us a negative 11,990, which matches our negative 11,990, right? So the net amount of your asset and liability should match what you ended off with your net defined benefit asset or liability account there. So that's what this quick check is for. So you can just check if you did it correctly, if everything went in the right spots. If this was a different number, this check, then you did something wrong. So you can go back and check where you went wrong. All right, so that's using the pension worksheet. Some people like using this format. Some people like what we did in question 2 of the part 1 class exercises. Make sure you know both ways. Like you may or may not have to do the pension worksheet, but make sure you know it. All right, so let's go back to our slides and we'll figure out how to do IFRS. So for IFRS, you're going to get the same answer for your defined benefit obligation and for your pension plan asset. You're just going to have, so your defined benefit obligation is exactly the same as IFRS and ASPE. Your pension plan asset account is going to be, you're going to get the same total at the end, but instead of doing your actual return, it's going to show up in 2 pieces. It's going to show up as your expected return and then as, I guess, as a difference between your expected and actual. Okay, so let me explain that in more detail. So pension expense for IFRS, you're going to start off with your current service cost. So that's the same as ASPE, right? So ASPE has this too. Then we're going to add our interest cost, which ASPE has as well. Again, interest cost is your opening DBO times your interest rate or discount rate. And then you're going to subtract your expected return on plan assets. Under ASPE, what ASPE does is ASPE subtracts the actual return. What IFRS does is they subtract the expected return. In order to get the expected return, what you're going to do, if it's not given to you in the question, is you're going to take your opening plan assets amount, opening balance of your plan assets, and you're going to multiply by the discount rate. Okay? So similar on how you get your interest cost. Okay? So take your expected return and multiply it. To get your expected return, take your opening balance of your plan asset account and multiply it by the discount rate. And then we're going to add our past service cost, which is the same as ASPE. Okay. So 3 of the components are the same as ASPE. For the expected return, it's different because ASPE does the actual return. Actual return is usually given to you in the case. To get the expected return, take your opening balance of your asset and multiply it by the discount rate. That's usually not given, so you might have to do the calculation. Another thing that ASPE has for your pension expense that IFRS doesn't are these actuarial gains and losses. I think I spelled that wrong. Gains and losses, which we don't have here in IFRS, and I'll show you where we incorporate those. Okay, so 4 things go into pension expense for IFRS, 5 things go into pension expense for ASPE. So it's a little bit different here. All right, so that's what we do for IFRS. So that your first journal entry is going to be this pension expense journal entry. Your second journal entry is the cash contribution, just like ASPE, but in IFRS we have a third journal entry we have to work with. So ASPE only has 2 journal entries, one for pension expense and one for the cash contribution. IFRS has those 2 journal entries plus one more. So let me explain what the other journal entry is for. So the other journal entry is the amounts will go into other comprehensive income. So there's 2 components that will go into other comprehensive income instead of going into pension expense. So I said that actuarial gains and losses were missing from pension expense. That is something that will go into OCI instead. So IFRS says we're not putting actuarial gains and losses in pension expense, we're going to put them in OCI. Okay, so what you're going to do is any actuarial gains, or if you have a gain, that's going to increase OCI, right? So any gain is going to increase OCI. If you remember OCI, the OCI account, other comprehensive income, is, I guess it functions the same way as a revenue account. So any increases will be credited, any decreases, so a loss, will be debited. Okay. So gain will increase OCI, a loss will decrease OCI, an increase is a credit, a decrease is a debit. Okay, so that's one component of OCI. The second component of OCI is going to be the difference between your actual return and your expected return. So your actual return doesn't show up in your pension expense, your expected return shows up in your pension expense. So in order to get that missing element of your actual return, the difference between your actual return and your expected return is going to go into OCI. So for example, if you invested the, well, not you, the trustee. So the pension trustee invests the pension money, and maybe they're expecting a return of $60,000, or sorry, let's say $60. So they're expecting that they're going to get a return of $60. They actually get a return of $100. Okay, so let's say they actually get a return of $100. So that's a good thing, right? They thought they'd get 60, they actually got 100. So the difference of 40 is going to increase OCI, and that's going to be a credit, right? Any increases to OCI get credited. However, if you expected a return of 80, but you only got a return of 40, actually let's say 50, so we have a different number at the end. So, but you actually got a return of 50, that means you were expecting 80, only got 50, so that's not a good thing, which means it's going to decrease OCI. So you're going to debit the difference of 30,000. Okay? So if your actual return is higher than your expected return, that's great. You thought you were only getting 60, you got 100. It's going to increase OCI, credit. If your actual return is lower than the expected return, that's not an ideal situation. You know, you thought you were getting 80, you only got 50. That's not very good, which means you're going to debit OCI. These 2 components together, the actual gains and losses and the difference between actual and expected, you can kind of take the sum of both of these and do one journal entry for your OCI. Okay, so if this is if you have an actuarial gain of 20 and it's going to be a credit, you would add that to the credit of 40, and then you would do a credit of 60. But if you have a credit of 20 here and a debit of 30 down here, then overall you're going to have a debit of 10. Okay. So let me show you what the journal entries look like. All right, so first journal entry is the same as ASPE, debit pension expense, credit net defined benefit. The second journal entry is the same as ASPE, debit your cash contribution, credit your net defined benefit. Third journal entry to record OCI, it's either going to be a debit or a credit to OCI, depending on how your numbers work out. So we're either debiting OCI, and any guesses on what we're crediting? We're crediting our net defined benefit. Your net defined benefit is always affected in these journal entries. Okay? So either you're debiting OCI and crediting a net defined benefit, or you're debiting net defined benefit. Just depends on like if you have actuarial gains or do you have losses, and the difference between actual So, or it's this way. So one or the other. So debit OCI and credit net defined benefit, asset liability, or debit net defined benefit, credit OCI. And so either way. All right, so let's try practicing that. Let's go to question number 2 on your worksheet. Okay, so go into the second tab, question number 2. I would recommend that you pause this video now and do this question on your own now that you know how to do the worksheet. So one thing that we're going to add to the worksheet is a column here for our gains and losses. So it can be called remeasurement, or it could be called OCI. So remeasurement gain or loss, or OCI. So we have a fourth column actually, that where we put those two components into OCI. Okay, so try to pause this video now. Try to do this. It's following IFRS. Do the journal entries, and then come back to this video and see how it was solved, and see if you got it. Okay. All right, so let's take this question up. So January 1st, the company had plan assets of 300,000, defined benefit of 250, and then it gives us all the other numbers here. So we can start putting this into our worksheet. So we had plan assets of 300,000, that's a debit of 300,000 there. We had defined benefit obligation, which is a credit balance, it's a liability of 250, so it's credit. And if we subtract the two, this time we have a net asset, right? 300,000 is greater than 250, so we have an asset of 50,000. And then we're just going to go down the list and look at the amounts and put them in wherever they go into the schedule. So current service costs, 27,500. Current service cost is going to affect our debit or pension expense, credit or liability. Right? So once you get comfortable with where things go, then it's just so easy to populate this the schedule. So interest costs we can calculate. We're going to take our interest rate or discount rate, multiply it by our defined benefit obligation. So 25,000. It gets debited to our pension expense and credited to our liability. Okay, so current service costs, interest costs go into the same columns. The next one we'll look at is our expected return on plan assets. So remember, under IFRS, we don't put our actual return, we put our expected return. Okay, so our expected return, how you're gonna get that. So let me just show you how you calculate that. So to get your expected return, we are going to take our discount rate, the same one that we use for interest expense or our interest cost, and we're going to multiply it by the opening balance of our plan assets. So that's your expected return, 30,000. Our expected return is going to decrease our pension expense. And I haven't told you where the debit goes, but if we're doing for IFRS, we're going to do our expected return, and then we're going to do the difference between our expected and actual. And we know our actual return goes into our asset account. So the expected plus the difference between our actual and expected should also go into the asset account. Okay, so we're putting 30,000 into our pension plan asset. We're debiting that. We want $45,000 of the actual return to go into our pension plan assets, but we're going to do it in 2 steps instead of in one. So under ASPE, you took this 45,000 and debited pension asset, but in IFRS, we're doing it in 2 parts basically. So we're going to do it the 30,000, and then the next thing is we're going to do the remeasurement of our asset. Remeasurement of asset is where the difference between the difference between expected and actual return come in. Okay, so we have an expected return of 30,000, right? So we expected We expected to get 30,000. We actually got 45,000. So that's a good thing, right? So the difference between the 45 and the 30,000 is 15,000. So that's a good thing because we only thought we were going to get 30. We actually got 45. So that's going to be a credit to our OCI. A credit to our OCI means a negative amount on our worksheet. Okay, so we'll go into the first column here, which is our new column that we made, OCI, and we're going to have negative 15,000 because it's going to be a credit to OCI. And we're going to also have a debit to our plan assets. We want our plan assets amount to show the 45,000, and it does now. So because if you take the 30,000 plus the 15,000, that's going to give you our 45. Okay? So our plan assets should be showing the actual return, but it's going to be showing it in two parts instead of one because the expected return goes into the pension expense. The difference between the expected and actual go into the OCI. So if both of these together will go into pension plan assets, and then we have our actual return in our pension plan assets. So just a couple more steps to get there for IFRS. In OSPI, we would have debited pension expense 45,000, sorry, credited pension expense 45,000, debited pension plan assets 45,000. Here, there you just got to do it in two steps instead of one. All right, so next, so we've dealt with that. Next, our past service cost. Past service cost was granted December 31st, 2016, 29,000. Okay, so it's going to increase our pension expense debit, increase our DBO credit. We have some contributions that were paid by the company. So $20,000 was paid out to the pension trustee. So we know that's going to decrease our cash credit, and it's going to increase our asset, which is a debit. Benefits paid were $17,500. Benefits paid does not affect anything in the general ledger, only the memo record. So it's going to be, and the reason why it's going to be a debit to your defined benefit obligation, a credit to your pension plan assets. The reason why it doesn't hit any of these amounts or the net defined benefit is because these two cancel out, right? If we debit our liability, credit our asset, these two cancel each other out, and therefore nothing will show up in the net defined benefit. Okay. And the last one here is an actuarial loss. Remember, for IFRS, an actuarial loss goes into OCI. If it's a loss, we debit OCI, so a positive balance, and we credit our DB or liability. Okay, so a loss is going to debit OCI, a gain is going to credit OCI. All right, so we're done using all the numbers, so we're going to total everything up. So let's do a total here. And then at this point, you can do your journal entries because then it's easier to fill out these at the end, right? So you can do your journal entries now if you'd like. First journal entry is your OCI. So if it's a negative amount, that means it's a credit. So we're going to credit OCI and debit net defined benefit. So we're going to debit our net defined benefit, credit our OCI. Pension expense, we're going to debit our pension expense. We're going to credit net defined benefit. And then this cash is going to be credited 20,000, which means our net defined benefit is going to be debited 20,000. So now we can fill the rest of our schedule because we can see the journal entries. So you can do this before or after the journal entries, but we know that we're going to be debiting net defined benefit of 5,000. So we'll have the debit of 5,000 there. We're going to be crediting net defined benefit 51,500. So minus credit balance there. We're going to be debiting net defined benefit 20,000. So if we start with our $50,000 asset, add 50,000 minus 51,500, add 20,000, we get a total of 23,500. The last thing we want to do is do a quick check. So to make sure that this number is correct. So here we have our defined benefit obligation, negative 324,000, pension plan assets, 347,500. So we're gonna just take the difference between them, and we get a positive amount of 23,500, which is the same as that there, right? So that is the same as this. Okay, so we're good here. All right. Just the one last thing I just want to quickly talk about is the other post-retirement benefits. So we've been talking about pensions. Just one more thing about pensions is the valuation of the pension plan asset. So usually what happens in most companies is that you have a net defined benefit liability. So usually companies' pensions are underfunded rather than they're overfunded. But if the net amount is an asset, there is a ceiling of how much the asset can be recorded at. So your net defined benefit cannot exceed the expected future benefits that the retired members are going to get. So if it does, then you'll have to reduce the amount. So there is like a ceiling test where the asset can't be above a certain amount. And if it is, then you're going to have to bring down the asset amount, and that change is recognized in pension expense. I just want to make a note there. So other defined benefit plans, so we just talked about pensions, but there are other benefit plans such as, maternity or paternity leave, health benefits, long-term compensated absences like sick leaves, stuff like that. So in order to deal with all of those, what we do is we don't have to do the crazy schedule or anything like that we did with our defined benefit plans. What we do is because we just use the accrual method. So for example, if there's parental leave or long-term disability leave, whenever there's the obligation to the company, we're going to debit the benefit expense, whatever it is, long-term disability benefits expense or parental leave benefit expense, and we're going to credit our benefit liability. And then when the cash is paid out by the company, we're going to debit our liability, credit our cash. Okay, so we just use the accrual method. When we incur the cost, we're going to have a liability. When we pay it out, we're going to get rid of the liability and pay the cash. Okay, so it's pretty straightforward for the other benefits, post-retirement benefits or parental leave, long-term disability plans. It's pretty straightforward. Yeah, and defined contribution plans are pretty straightforward too. The big difficult part in this chapter is the defined benefit plans and doing that worksheet, making sure you know the differences between ASPE and IFRS, and making sure you do the journal entries correctly. All right, so I hope this was useful information for this chapter. Thank you for listening. Take care.